Thank you, Nathan and Gennady, for inviting me today to speak to you all, and thank you very much for listening to the talk today. I have a short video to play in a second, but I'll just give a brief introduction to Eastern Gas. We're coming out of pure hydrogen, who have had the assets for quite some time, and they've now focused on the hydrogen side of the business, and we'll be basically here to realise the value of their legacy gas assets in Queensland. And that's quite straightforward. They've drilled a number of wells which has allowed them to have certified gas resources in the ground, substantial gas resources in the ground, and it's in a market that's in desperate need of new projects, and we're close to the gas infrastructure for East Coast.
Introducing the Eastern Gas initial public offering, providing investors with exposure to a business with two 100% held Australian natural gas assets. Our highly advanced tenements are located on two prolific gas sites in Queensland. The Windora Gas Project in the Cooper Basin boasts 330 billion cubic feet of gas, with 4.4 trillion cubic feet in potential reserves. Project Venus in the Surat Basin has 123 billion cubic feet of gas, with 536 petajoules in potential reserves. With over $45 million invested in exploration and development, these assets are primed for commercialisation, backed by well-defined drilling programs and established infrastructure links to domestic and export markets. Australia faces rising gas prices and looming shortages, with current prices exceeding $10 per gigajoule and forecasts predicting increases to $12 to $15. Favourable market conditions support new suppliers like Eastern Gas, as natural gas is essential for energy security and is critical to Australia's transition to lower emissions. Eastern Gas is positioned to capitalise on these trends, delivering value in a market forecasted to see sustained high demand. Led by seasoned industry experts, Managing Director David Spring and Chairman James Canning-Yor, Eastern Gas is backed by decades of combined experience in commercialising gas projects. Now is the time to invest in Australia's energy future.
Well, let me first start with just talking about the assets that we have. As you heard in the video there are two gas assets, and they are in the two most prolific and productive gas basins in Australia. And in fact, Cooper Basin is world-class in terms of its source rock. So the first one over on the right, which is a Project Venus that we call it, ATP 2051. It's in the Surat Basin in Queensland, and it is in the coal seam gas play there, prolific, they call Walloons coal measure CSG play. And we have contingent resources of 130 petajoules there, 150 or so petajoules of 3C. And in fact, it was mentioned there that over about 500-600 of potential resource as well. So we're going to be focusing on the shallow coals, the high quality coals, which are the contingent resources there. So we'll be aiming to move those contingent resources into proven reserves in the short term, and I'll talk about that in a moment. Over in the west, we have the Cooper Basin play, which it's a basin centre gas play, ATP 927, Windora Gas Project it's called. And I've already mentioned the Cooper Basin is actually the premier hydrocarbon basin, onshore basin in Australia, with the best source rocks and the best reservoir in the country, and we're in the middle of that. And we have proven resources in 2C category of 350 petajoules, 800 3C petajoules, and you heard on that video that there's about 4.5 of potential resource that we can access, recoverable, probably close to 2 TCF of gas there. So it's a large project. It's had 4 wells drilled by Pure in it. They've produced in excess of 2.5 million cubic feet a day out of one of those wells. So the productivity's there. We have to go in there and demonstrate that we can do it over a long term across the entire block. That one has got a potential commercial area designation to it, which means that we have 15 years to execute a program to get to commerciality before we start producing. So because of that, we do believe there's a lot of potential value there, but we have quite some time to actually go in there and execute a program. So that's our secondary objective at this point in time. Our objective of the IPO is to get the funding to move the project Venus forward. And you can see both of those there. Just the green lines of the gas is the basic gas infrastructure for the East Coast. And Project Venus feeds into the Wallumbilla, which is the hub for that particular area. And Windora project is very close to Santos operator infrastructure, which goes into the Moomba complex and processing facility, and we have a pipeline approval to access that. So it's in two fantastic geological addresses and fantastic logistic addresses as well. So let me talk about Project Venus. There's a lot happening in this slide, lots of colour, which is always good in geoscience. So the green you can see there is, there's about 10,000 of them, and they are CSG wells. Almost all of those are still producing, and what they do is define the play area for the Wollongong coal measures, and you can see them going from the southwest to the northeast, and then from the southeast up to the northwest. And what you see there are clumps of green drilling, or clumps of wells, and then areas without any drilling. And that's not because the coal's not there, that's not because it's poorer quality, because in fact across that entire horseshoe, the quality of the coals are consistent, high gas concentrations, thick, over 150 metres of total thickness of the seams, and are producing each one of those wells at extremely high rates, and apart from being just productive, you get payback on the wells in just 2 or 3 months, so a really high value play. Anyway, the reason why there are the breaks, if you like, or the holes in the middle, is principally because the operators are just fulfilling their current gas sales commitments, and as they require more resources to fulfil those commitments, they then go into the next block, drill those out, and then drill the next. And so what you will see, not probably, you will see in the next 10 years that area will be totally covered with a lot of those green dots. So who are the players in there? The different colours, the checkerboard. There's Santos here, there's QGC, APLNG, Arrow Energy, all multi-billion cap companies in this play. We are, in the dark blue in the middle, the only junior in the entire area, which I think is a fantastic position to be in when you've got all the largest companies in Australia and the world in a play, and to have a piece of that. And so it's in a fantastic address from that point of view as well. The one thing about those bigger companies is that 90% of the gas that's produced here, which actually produces 90% of Queensland's gas, is actually exported to the LNG market. So all those big players I just mentioned, they're all exporting out of Gladstone. There's one outlier in there, and the outlier is in blue up in the northern area up there, is Senex Energy, and I had the pleasure of working with them. In fact, they brought me back to Australia about 10 years ago, and I was part of the company when we went from being a Cooper Basin player only to being a significant coal seam gas player. So I've seen how you do that, and I've seen the company develop, and what they've done is they've really set a benchmark for the valuation of the resource within this particular area. And what I mean by that is that Senex picked up, they had a couple of blocks back 7 or 8 years ago. They were then bought out by POSCO and Gina Reinhardt's company, and they paid $1.50 a gigajoule for proven reserves. They paid $900 million for Senex Energy. Subsequent to that, they have then gone into this area which is highlighted number 1 there. They bought proven reserves from QGC and paid $2 a gigajoule for the proven reserves. And in addition to that, number 3, just down to the southeast of that, they acquired 50% of a project range from Central Petroleum. They paid 10 cents a gigajoule for contingent resources. So we're just looking at that. And by the way, this was done at a time when the gas price was about $8 or $9 a gigajoule. It's currently 13 to 15. So you take the valuation that they were doing at that time, probably add another 50%, 40% to those. The important thing there is it demonstrates that the value of the contingent resource is 1/10, 15th of what is considered for a proven reserve. So take that, we have contingent resources in this block. We have 140 of 2C and we've got substantial prospective resource as well. So just on a valuation basis, to move that our contingent resource to proven, we can see a considerable increase in the value of the asset just based on that alone. And the other thing in here, you can see that all the red lines in there is the gas infrastructure, which also now includes all the export infrastructure as well. We have a pipeline 7 kilometres from the block. So in the event that we have success and want to go to production, then we can get to the market very, very, very quickly and pretty inexpensively from a capital point of view. Wells are 400 metres deep. We're going to be drilling horizontal wells, $2 million a well, which is significantly cheaper, obviously, than you're doing offshore, and significantly cheaper than the other plays in the region, which are down to 3, 4 kilometres of depth. I think that's all I need to say on that one. So why invest in us? I think it's pretty straightforward. First one, we are 100% owner and operator of the block, and in this case, I think that's really important because we can focus all of our shareholder money and from the IPO into creating value for Eastern Gas. We don't have any partners that we have to quibble about and have different strategies and objectives. Here we just put it straight into what's important and what will create the most value for Eastern Gas. We have an experienced board. It's small, but we've taken projects, all of us, have taken projects from IPO through execution, through to sales, or either selling the company or into production, in my case, of large gas fields. It's, as you've seen, we're close to the infrastructure, and that infrastructure, as I mentioned earlier, goes into the East Coast, which has an incredible imbalance in future between the demand and supply, and has gas price increasing. So the value of these will only increase with time, the blocks will only increase with time, which is the fourth point there. We can be disciplined about what we do here. All we want to do is we want to get our funding, put it straight into wells in the short term, and execute that program to create the value. And our IPO is really priced at creating that value, and you'll see in a moment. And that we've got strong leverage to the catalyst, so the catalyst is the drilling, and that's what creates a value by moving, as I said, those contingent resources over to be proven reserves. Just a quick comparison to our market peers. Our peers in this case, we've taken gas companies, if you like, onshore, similar assets, and similar stage of maturity of their projects. We're perhaps a little earlier than some and around about the same as the others. But what we've done is we've looked at the enterprise value of those companies, and they're all listed, versus the resources they have in the ground, and we come up with an average of about 20 cents a gigajoule for those across our peer groups. We are pricing our IPO at less than 3 cents a gigajoule. So our objective as a board and the leadership team is to move that towards the average of that group or better. So that's a 6 or 7 times increase in the value for an IPO that we're aiming at by drilling our program. And finally, what we are doing is we're looking to raise $5.5 million. That money will be 100% spent in Project Venus 2051 with the drilling of the horizontal wells. And we will be we'll commence that in the first quarter of 2026, and we'll have results of those wells within 30 days. So we'll know pretty early, quickly, how successful we are in drilling those wells. We'll then undertake testing, which will be 6 months. So 12 months from today, we will have a very good idea of how we've moved the bar from the contingent resources up to proven reserves. So as I said, we're 89%, 90% of the money is going into the ground immediately. And it's a pretty straightforward deal. It's simple structure. And we think that makes it very attractive for investors. So that's it. Thank you very much. Great. Thanks a lot.
Thank you very much,
Cheers.
David Spring from
Thank you.
Eastern Gas. Exciting.